Ever dreamed of finding the perfect ETF for your investment strategy? One that offers diversification, steady growth, and long-term peace of mind. Today we're embarking on a quest to uncover the holy grail of ETFs, a fund you could confidently buy and hold forever. We'll explore 3 powerful contenders, each with unique strengths that could transform your financial future. By the end of this journey, you'll have the knowledge to choose an ETF that aligns perfectly with your long-term goals. Get ready to discover how these funds can help you build lasting wealth and secure your financial future. As we continue our quest for financial freedom, we encounter the broad market sage, a guardian of diversification wisdom. This enigmatic figure challenges us to look beyond the familiar names and explore the true power of market exposure. Did you know that a single ETF could give you ownership in hundreds of companies? It's a concept that might seem too good to be true, but it's the reality of broad market ETFs. The broad market sage poses a thought-provoking question. Is safety found in the comfort of well-known companies, or does true security lie in embracing the entire market? It's a tension many investors face, torn between the allure of big-name stocks and the stability of widespread diversification. Let's break down this concept further. Broad market ETFs come in 2 main varieties: market cap weighted and equal weight. Market cap weighted ETFs, like the popular SPYDR S&P 500 ETF, tend to have higher concentrations in larger companies. This approach reflects the current market structure but can lead to a heavier influence from tech giants and other industry leaders. Equal weight ETFs, on the other hand, distribute their holdings more evenly across all companies, regardless of size. The broad market sage reminds us of the incredible resilience these investments have shown over time. Broad market ETFs have weathered economic storms, market crashes, and periods of uncertainty with remarkable consistency. This historical performance isn't just about surviving tough times, it's about thriving over the long haul. Consider this. The long-term performance of broad market ETFs has consistently outperformed many individual stock-picking strategies. It's a testament to the power of diversification and the difficulty of consistently beating the market through individual stock selection. This fact often surprises investors who believe they can outsmart the market with clever picks. But what about common misconceptions? Many view broad market ETFs as boring or average investments. The broad market sage challenges these notions, revealing how these seemingly simple investments can be powerhouses of wealth creation. The key lies in understanding the magic of compounding and how it works over decades. Imagine your investment as a snowball rolling down a hill. At first, growth might seem slow and unremarkable, but as time passes, that snowball picks up more snow and momentum. In the same way, a broad market ETF, reinvesting dividends and capturing the growth of hundreds of companies, can create a compounding effect that significantly enhances returns over long periods. This steady growth leads us to one of the most compelling aspects of broad market ETFs. They offer what many call a sleep well at night strategy. There's a profound peace of mind that comes from knowing your investment is spread across a vast swath of the market, reducing the impact of any single company's performance on your overall portfolio. Think about it. Instead of fretting over the quarterly earnings of a handful of stocks, you're tapping into the collective growth of entire industries and sectors. It's a strategy that aligns well with the sage advice to never put all your eggs in one basket. With a broad market ETF, your basket includes hundreds of eggs, each representing a piece of the economic pie. Picture this. You wake up one morning, check your bank account, and find a fresh deposit from your investments. No, you didn't sell anything. This is just your portfolio doing what it does best, generating passive income. Welcome to the realm of dividend ETFs, where your money doesn't just grow, it pays you. But before you get too excited, there's a crucial trade-off to consider. Are you ready to unlock the secret to generating passive income without sacrificing long-term growth? As we continue our financial quest, we encounter the Dividend Oracle, a wise figure who holds the keys to income-generating wisdom. The Oracle beckons us with the promise of regular payouts, but warns that this path comes with its own set of challenges. Dividend ETFs, the Oracle explains, are like fruit-bearing trees in your financial orchard. They provide a steady harvest, but you must choose carefully between those that offer bountiful crops now and those that grow stronger over time. Let's break down what the oracle means. Dividend ETFs come in two main varieties: high yield and dividend growth. High yield ETFs offer juicy dividends right away, while dividend growth ETFs promise increasing yields as they mature. Each has its place, but understanding the difference is crucial for your long-term strategy. Now you might be thinking, steady income sounds great, but what about overall returns? This is where the concept of total return comes into play. Total return considers both dividends you receive and the potential increase in the ETF's value over time. It's like counting not just the fruit you pick, but also the growth of the tree itself. Here's where things get interesting. While dividend ETFs can provide a reliable income stream, they typically don't outperform broad market ETFs or growth ETFs in terms of total return. Why? Because these companies are distributing profits to shareholders rather than reinvesting them for growth. It's a trade-off between immediate income and future potential. But don't write off dividend ETFs just yet. They have a secret weapon: stability during market downturns. These ETFs focus on established companies with strong profit histories, which tend to be less volatile when the market gets choppy. It's like having a sturdy tree in your yard that stands strong even when economic winds blow. Now let's talk about some top performers in this category. High-quality dividend ETFs like the S&P Dividend Aristocrats ETF, SDY, iShares Core Dividend Growth ETF, DGRO, and Vanguard Dividend Appreciation ETF, VIG, are recommended for consistent income generation. These ETFs have proven track records of delivering steady dividends, making them popular choices for investors seeking reliable cash flow. But here's something to keep in mind: taxes and reinvestment. Dividends are typically taxed as ordinary income, which can impact your returns. However, reinvesting those dividends can significantly enhance long-term wealth. It's like planting the seeds from your harvest to grow even more trees. Over time, this compounding effect can turn a modest investment into a substantial sum. Remember those dividend growth ETFs we mentioned earlier? They have a special superpower: the ability to create a pay raise every year effect for investors. As the companies in these ETFs increase their dividend payouts annually, your income grows too. It's like getting a promotion at work every single year without having to ask for it. So what's the verdict from the Dividend Oracle's test? Dividend ETFs offer a unique blend of income and stability, making them an attractive option for many investors. They may not provide the explosive growth potential of other strategies, but they offer something equally valuable: consistency and peace of mind. As you continue your investment journey, consider how dividend ETFs might fit into your overall financial strategy. Picture this: you're at the forefront of a technological revolution, and growth ETFs could be your ticket to investing in the next world-changing companies. Enter the Growth Guru, a financial advisor with a keen eye for the next big thing. But remember, where there's potential for high returns, there's also significant risk. Growth ETFs are investment vehicles focusing on companies with high potential for capital appreciation. They target cutting-edge tech firms, innovative healthcare startups, and consumer brands poised for rapid expansion. These ETFs aim to capture tomorrow's industry leaders today. Let's look at some numbers. Over the past 5 years, some growth ETFs have delivered average yearly returns of over 20%. The QQQ, which tracks the NASDAQ 100, has outpaced many other investment strategies. However, these impressive returns come with considerable volatility. Imagine browsing a tech conference showcasing the latest innovations. That's what a growth ETF's portfolio might resemble. These funds often have a heavy tilt towards technology, with major holdings in companies like Apple, Microsoft, and Nvidia. It's like having a stake in the future of innovation. Growth ETFs aren't limited to tech, though. They come in various flavors, each with its own approach to potential success. There are tech-focused ETFs, small-cap growth ETFs betting on up-and-coming companies, and thematic ETFs targeting specific trends like renewable energy or artificial intelligence. Now let's address the risk factor. Growth ETFs can be unpredictable with rapid ups and downs that might keep some investors on edge. This volatility is the trade-off for potentially life-changing returns. Investing in a growth ETF is like planting a diverse garden. Some investments might not flourish, but a single high-performing stock can drive outsized returns that make up for underperformers. It's this potential for exceptional growth that attracts many investors. Keep in mind that these potential rewards don't come cheap. Growth ETFs often have higher expense ratios than more conservative options. It's similar to paying extra for premium seating at an event. You're closer to the action, but at a higher cost. So why consider this higher risk investment? Because growth investing plays a crucial role in long-term portfolios. It's about positioning yourself to benefit from future economic shifts. As the world evolves, growth ETFs adapt, capturing emerging trends and disruptive technologies that could define the next decade. Case studies show how growth ETFs have capitalized on major tech trends like cloud computing and artificial intelligence. These weren't just buzzwords, they represented significant shifts in the business world, and growth ETFs provided investors a way to participate in these transformations. The Growth Guru wants you to understand that while the potential rewards of growth ETFs are enticing, they require careful consideration. These investments can be a valuable component of a diversified portfolio, offering exposure to innovative companies and emerging trends. However, their higher volatility means they're not suitable for everyone. As you weigh the pros and cons of growth ETFs, consider your risk tolerance, investment goals, and time horizon. Are you comfortable with short-term fluctuations for the chance at higher, long-term returns? Can you weather the storms of market volatility without panic selling? These are crucial questions to answer before diving into the world of growth ETFs. Ever felt like you're standing at a financial crossroads, unsure of which path to take? Well, you're not alone. When it comes to choosing the right ETF strategy, your age might be the secret weapon you've been overlooking. It's like having a compass that points you towards your ideal investment future. Let's look at two investors, Sarah, a fresh-faced college graduate, and Tom, who's counting down the days to retirement. Sarah's just landed her first job and dreams of buying a house in 10 years. Tom? He's focused on maintaining his lifestyle without a paycheck. Both are eyeing ETFs, but their ideal strategies are worlds apart. Sarah has time on her side. With decades ahead, she can afford to take on more risk. Growth ETFs might be her best bet, offering the potential for higher returns over the long haul. Market dips? No problem. Sarah has time to ride out volatility and potentially benefit from compound growth. Tom's picture is different. With retirement looming, he's all about preserving wealth and generating income. A mix of broad market ETFs and dividend ETFs could be his go-to, providing stability and regular payouts to support his golden years. Your risk tolerance evolves as you do. When you're young, you might feel ready to take on any financial challenge. As you age, you might prioritize stability over potential windfalls. It's not just about your age, it's about your goals, dreams, and even fears. Understanding your true investment timeline is crucial. Are you saving for a down payment in 5 years, or building a nest egg for a retirement decades away? These timelines should shape your ETF strategy like a master sculptor crafting a masterpiece. Now let's talk about behavioral biases. We're all human, and that means we sometimes make less than rational decisions about money. Loss aversion might make you hold on to a losing investment too long. Overconfidence could lead you to make risky moves. Recognizing these biases is key to staying on track, even when emotions run high. Here's a mind-blowing fact. Starting early with any ETF strategy can supercharge your wealth accumulation. It's all thanks to compound returns. Think of it like a snowball rolling down a hill, getting bigger and bigger. The earlier you start, the more time that snowball has to grow. ETFs are flexible enough to adapt to your unique life situation. Your income level, family obligations, retirement goals, all these factors should play a role in shaping your ETF selection. It's not about finding the best ETF, it's about finding the best ETF for you. Maybe you're a high-earning professional with a taste for risk. A growth-focused ETF strategy might align perfectly with your goals. Or perhaps you're juggling a mortgage and kids' college funds. In that case, a more balanced approach with broad market ETFs could provide the stability you need. The key is to be honest with yourself about where you are in life and where you want to go. Your ETF strategy should be as unique as your fingerprint, tailored to your personal financial DNA. Welcome to the world of personalized ETF blending, where you can craft a portfolio as unique as your fingerprint. Imagine combining the steady growth of broadband market ETFs, the income potential of dividend ETFs, and the power of growth ETFs into one harmonious strategy. Let's explore this hybrid approach that's revolutionizing investing. Personalized ETF blending is about finding the perfect balance between simplicity and customization. It's like conducting an orchestra where the different ETF types complement each other for optimal results. Broad market ETFs provide the steady rhythm, dividend ETFs add a harmonious melody, and growth ETFs deliver those thrilling high notes. When combined skillfully, these elements create a symphony of financial performance that's greater than the sum of its parts. The secret lies in understanding popular ETF combinations that have stood the test of time. Take the 3-fund portfolio strategy, for instance. This approach typically includes a mix of U.S. stocks, international stocks, and bonds. For example, you might allocate 60% to a total U.S. stock market ETF, like VTI, 30% to an international stock ETF, like VXUS, and 10% to a broad bond market ETF, like BND. This balanced investment can weather various market conditions. But why stop there? You can fine-tune your blend to capitalize on emerging trends or boost your income. Maybe you want to add sector-specific ETFs or high-yield dividend ETFs. The possibilities are vast, but remember, the goal is to create synergy, not chaos. Even the most perfectly composed portfolio needs regular tuning. That's where rebalancing comes in. It's essential in a multi-ETF strategy to maintain the desired asset allocation and capitalize on market fluctuations. Experts often recommend rebalancing annually or when your allocation drifts more than 5% from your target. One potential pitfall to watch out for is over-diversification. Striking a balance between simplicity and customization is key. Remember, the goal is to create a portfolio that's tailored to your needs, not to collect every ETF available. So how do you find that sweet spot? It's all about understanding the synergy between different types of ETFs. Your growth ETFs provide the potential for long-term wealth accumulation. Your dividend ETFs offer a steady stream of income, perfect for reinvesting or covering living expenses. And your broad market ETFs act as stabilizers, smoothing out the ride through market turbulence. A personalized ETF blend can be seen as a comprehensive solution that caters to your individual risk tolerance and investment goals. It provides a robust strategy that can adapt to changing market conditions and personal circumstances. It's like having a financial strategy that grows with you, adapting to your changing needs as you progress through life's journey. In the end, the beauty of a personalized ETF blend lies in its flexibility and potential for optimization. By carefully selecting and combining different types of ETFs, you can create a portfolio that's not only diversified but also aligned with your specific financial objectives. It's a powerful approach that can help you navigate the complex world of investing with confidence and precision. Choosing your forever ETF is a pivotal decision that could shape your financial destiny for decades. It's like selecting a lifelong financial companion, one that will be with you through market highs and lows, economic booms and busts, and all the twists and turns of your personal journey. Let's recap what we've learned about each ETF category. Broad market ETFs offer unparalleled diversification and have consistently outperformed many other strategies over the long haul. Dividend ETFs provide a steady income stream and can offer stability during market downturns. Growth ETFs have the potential for explosive returns, particularly in sectors like technology. The fear of making the wrong choice can be paralyzing. What if you pick an ETF that underperforms? What if you miss out on the next big trend? These concerns are valid, but remember, the cost of inaction can be far greater than making an imperfect choice. One approach gaining traction among savvy investors is the core and explore strategy. This involves having a core holding in broad market ETFs while exploring other categories like dividend or growth ETFs for additional potential. It's a way to have your cake and eat it too, benefiting from the stability of broad market exposure while still having the opportunity for enhanced returns. When choosing your forever ETF, don't overlook fees. With an investment horizon of decades, even small differences in expense ratios can have a massive impact on your returns. Lower expense ratios mean more money stays in your pocket, enhancing overall returns over a 30-plus year horizon. One of the biggest challenges you'll face is staying the course during market turbulence. It's easy to stick with your strategy when markets are booming, but what about when they're crashing? This is where many investors falter. They panic during downturns, selling at the worst possible time and missing out on the eventual recovery. Remember, a well-chosen ETF strategy is designed to weather these storms. Common mistakes investors make when selecting forever holdings include focusing too much on past performance without considering future potential and neglecting the importance of diversification. Investing heavily in specialty ETFs with high concentration in one sector can lead to increased risk and potential losses. The transformative power of a well-chosen long-term ETF strategy is truly exciting. Imagine having a financial strategy so robust that you can focus on your life goals without constantly worrying about market fluctuations. A strategy that provides consistent returns and peace of mind, allowing you to sleep well at night knowing your financial future is on track. After careful consideration, I lean towards a broad market ETF with a low expense ratio and a strong track record of performance for my forever ETF. Why? Because it aligns perfectly with the criteria for long-term investment success: diversification, consistency, and cost-effectiveness. It's like planting a mighty oak tree. It might not grow as fast as some other investments in the short term, but over decades, it has the potential to provide substantial, reliable growth. Congratulations! You've completed your quest through the world of ETFs, but the real journey is just beginning. The best ETF isn't about highest returns or lowest fees. It's the one you'll stick with through market ups and downs. Your next step? Choose your ETF and commit to a regular investment plan. Think of your investment journey as a marathon, not a sprint. Each contribution is a step towards financial freedom. As you review your ETF portfolio, keep your long-term goals in sight. Your risk tolerance and desired returns will guide your choices. Are you ready to take control of your financial future? With the right ETF strategy, wealth is within reach. Start your journey today. Picture yourself reaching the summit of financial success, with each investment bringing you closer to the top.